Stocks got hammered today. We did see the S&P 500 fall by about 6%. The Russell 2000 small cap index was down about 7%, and even the stalwart Nasdaq was down 5% today. This was the worst day of losses for the U.S. stock market since March 16th. Actually, one of the worst days on record, one of the 25 worst days in history for the S&P 500. So a really ugly day across the board. We did see plenty of signs of froth leading up to it. Had a feeling something was going to give. I mentioned on Tuesday that that wasn't enough of a sell-off to call it a rug pull type of a day. Today was the rug pull. Today we saw all kinds of travel and leisure stocks, all kinds of banks, all kinds of oil companies fall flat on their face. So we're going to dig into all of that, see what it means for our posture. We'll then also take a look at a trade application example in a stock that was off to the races up until today and fell along with the rest of the market, is now at a more acceptable level to be purchasing outright for a long-term investment. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's June 11th, 2020. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel. While you're over there, check out our description area and make sure you're signed up for our email distribution list. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZee, and we appreciate those of you that click like and retweet on these Market Outlook related posts. Lastly, we do have a presence on Facebook as well. Feel free to go to the web address you see there in the logo in front of you for our group. All right, let's go ahead and jump into our charts now. And as you can see, I've got kind of a familiar chart pulled up here. Reminds us of the times back in March and April where I would bring this chart up whenever we'd have at least a 1% type of a move. We haven't had a whole lot of those recently, but you can see the outsized effect of today's candle. So this red bar that you see right here for the S&P 500 reminds us of how aggressive of a day this was. And again, just to make sure we've got it down, it was 5.89% drop in the S&P 500 today, and you can see that that would take us back to some of these bigger candles. This one on the 16th, which was actually the worst day. Since that day, we haven't had a sell-off as large as we just experienced here today. However, I don't know about a lot of you, but it didn't really affect me personally all that much compared to what you would have assumed. I was texting with David earlier and was saying that it kind of felt like March and April were like, you know, a batter, if you're familiar with baseball, in the on deck circle, using the donut or the weight on their bat, kind of taking their swings, getting ready for the fastball, and then when they actually get up to the plate, the bat feels really light and they can swing it really fast. And so that's what it kind of felt like to me today. Normally, a 6% drop in the market would have knocked your socks off. But I think because a lot of us had just gone through March and our memories are still fresh from there, today didn't feel as ugly as it probably should have. You know, and I think there were, you know, in some cases, some opportunities to lighten up on your bullish positions in recent weeks, take some bearish trades as we have on occasion here, and even do some things like selling calls. And so today was kind of a reset type of a day, and also reminded us that the market is back to having some rationality. It seems like for a while there the market was just way off course and really goofy things were taking place. So anyway, a huge down move in the market today. Notice down below the purple line, that represents the VIX. We had a huge spike in the VIX today, and we're back up at 40 on the VIX. We were just down here in the mid-20s just in the last couple of days. So that's a huge surge in the VIX. That means that there might be some opportunities for those of you that enjoy selling premium. Of course, tomorrow I'll be teaching my options for long-term investors class, and we'll be looking at some brand new sold put opportunities. So if you are a premium member, be sure to join us there. We've had a heck of a run of things here in the last few months, and I expect that to continue. Anyway, let's go ahead and show you a slightly different vantage point of the market, just to kind of stress how big of a day it was. Back over here on the Market Watch tab now, I'm in the visualize area, and I've got the index watch with the S&P 500 pulled up. Notice here that there was one, yes, count them, one stock in the S&P 500 that was up today, and I believe that stock was Kroger. There were a few others outside of the S&P 500. I noticed that there were a couple more in our top-down trend trading class account, like Zoom and DocuSign, that were also up, but they're not in the S&P 500 quite yet, I guess, at least from this version here on the Thinkorswim platform. So this one and only one right here is from good old Kroger, a grocery store company. Kind of reminds us again of those times in March where not a whole lot was working. Some of the more boring areas like some grocery stocks or some consumer staples were starting to come into favor. So I don't know if we're going to get there this time around. This has been such an aggressive rally to the upside off of the March lows that the way that I'm planning on playing it myself is using the lows in stocks that we experienced in the middle of March versus where we're at right now, asking myself, which stocks did I miss on the big rally back up? And now that I have some clear markers, I'm going to start legging into more and more positions as they go back down to those March lows, if they do. I don't know that they will. But the point of me telling you that story is that I have a higher amount of confidence now that those lows back in March should hold. Now, of course, anything is possible, and we might have another terrible round of COVID-19 or what have you, so you have to be prepared for anything. But I will say that if we hadn't gone up as much as we did since March, I think my nerves would have still been set in where I wasn't as convinced in my own mind that we were carving out that bottom. But because the rally was so furious to the upside, I feel a little bit more confident in looking for those higher quality names. And if they continue to dwindle lower in coming weeks, I'm going to start scaling into my positions between where they're trading right now versus where their lows were back in the middle of March. We'll see if that works or not, but high quality stocks are always in demand if you've got a long enough time horizon, which I typically do as a dividend growth investor. All right, let's get back into a few more charts here now, and come on over here to chart 4B, and this will be our market forecast 4 grid here. Somewhat surprisingly, we actually still have bullish intermediate postures on all 4 of our charts, and that just goes to show you how quickly the market rose out of the bottom in the middle of March. If we are still, even after a huge meltdown day like we had today, still in bullish territory. Now, there is one thing I did want to point out that is a bit different today compared to where we were at just a couple of days ago when I last did the presentation, and that is on the Russell 2000. Again, the Russell 2000 was down 7.58% today. You'll see that after this 3-day sell-off that we've had on the Russell 2000, we are now trading just a hair below a falling moving average. Now, I know that visually because you can see that the moving average itself has turned red, and so that's kind of the visual that we've kind of assigned to it with our ThinkScript programming code. Remember, those of you that are premium members have access to all of our premium charts as well. Anyway, that is a slight difference, so be aware of it because it's telling us that, hey, after getting a little bit excited about some of the small cap stocks, today with that rug pull type of a day is reminding us that there's also a lot of risk with small cap companies. In fact, that was a big part of our conversation in my factor-based swing trading class yesterday. So feel free to check out that recording if you're interested in that. But anyway, that's something we got to watch out for. Now, the Nasdaq Composite is interesting because in the last few sessions it's been hitting 10,000 for the first time ever. Today it gave up, of course, a big chunk of that. We're back down here. But why it's interesting in my eyes is you will see that we actually have a bullish intermediate confirmation signal on the Nasdaq Composite. A reminder of what that signal is, it's when the green line is considered bullish. And remember, as long as it's in the upper reversal zone, it doesn't matter if it's falling like it is right now or rising. As long as it's above 80, we consider that bullish. If it's ever below 80, then it needs to be rising between 20 and 80. So right now, it's in the upper reversal zone. We're good there. So it means we have a bullish intermediate posture on the Nasdaq. Now that's combined with the red line, the momentum line, in the lower reversal zone. That one can't just be traveling lower. For the signal, it actually has to be in the lower reversal zone on that day of the signal, and that's where we do have it right now. And then lastly, while this is not part of the signal itself, you guys have heard us talk about, in fact, I just talked about this on Tuesday because we were talking about how the S&P 500 had a bullish intermediate confirmation signal right here, but I said be careful with that because that's not much of a dip, and I was explaining that inhale exhale philosophy, and there really wasn't enough of an exhale to get excited about a buy the dips mentality right there. And obviously those of you that waited on that for a legitimate exhale were quite happy with that after seeing where we're trading at this moment in time. But remember, 2 days ago, the red line on the S&P 500 was in the lower reversal zone, but at that time the blue line was still in the upper reversal zone. And I said we'd like to see that for a nice healthy exhale between 50 and 20 at a minimum there. And that's what we have now on the Nasdaq Composite. So notice that we've got the green line that is considered strongly bullish, the red line in the low reversal zone, and now we have the blue line firmly between 20 and 50. And if you look at that chart and you eliminate the pain of today of a 5% meltdown, and you just simply look at that chart, it does look somewhat appetizing, right? That's an uptrending security right there. And while we've had a pullback, which is natural and healthy for any market, we are still trading above a rising moving average. So the path of least resistance for the Nasdaq is still up despite today's beatdown. Now that can change, right? And that's why we look at these charts every day. And if we start trading a lot below the 30-day moving average, our attitude will change about that as well. But at this exact moment in time, without knowing what's going to occur in the future, this would be one of those legitimate buy the dip signals that we have here. There is one tiny fly in the ointment with this that I should point out. And that is that the red line is down here at 0.05. And typically when it goes below 5, we think that that is an extreme move on the momentum line, and it could be a sign of a potential change in posture if that is to occur repeatedly. Now you will notice that we had these other times like that back here. Here was an example of it on April 28th where it was at an extreme reading as well, and that would have been associated with that candle, and of course we continued to go up. We had the same thing unfold right here on May 12th, and that was associated with this candle, and it continued to go up, and the same thing happened again right here on May 19th with that candle, and it kept going up. So, will that eventually change? Sure, it's possible, but what I can say is that we have not seen an ultra-low momentum line wreck this furious rally that we've been in since the middle of March. Obviously, things can change if earnings come out negatively, if unemployment skyrockets, if we have a second wave of COVID crisis hitting the country, all those things obviously impact markets. But right now, from a technical perspective, it's kind of an interesting setup that we have right there on the Nasdaq Composite. We actually have a bullish intermediate confirmation signal here on the S&P 500 as well. But in this case, notice that the blue line is in the lower reversal zone, so it's below 20 there. So again, not an ideal setup. However, we are right sitting at the moving average. And you'll notice the last time we were sitting at the moving average on the S&P 500 was right here, and we bounced nicely off of it. Now that was a little bit more of a gradual decline into the moving average. This was, as I mentioned before, a rug pull, straight down elevator type of a move. So there may be a little bit more back and forth between the bulls and the bears this go around. But nonetheless, at least we're setting ourselves up for the possibility of a bounce at around these levels. And you can also see that we had kind of a double top back here from the middle of May, and also right here on the 29th of April. And some of you are familiar with that idea of a breakout retest. We had that breakout above that horizontal resistance area right there with that double top. And so it is possible that if we have a little bit of a dip quick tomorrow or perhaps early next week, that we catch a little bit of a bounce at around that area as well, stabilize, and then work our way back higher again. We also have a bullish intermediate confirmation signal on the Dow Jones Industrial Average, but same concept there. Blue line's in the lower reversal zone, so it's not considered an ideal setup. And then not to be outdone, we also have the same setup down below here on the Russell 2000. So today we have bullish intermediate confirmation signals on all 4 of our charts, the one that looks like it's the best setup for those of you that are trying to practice that buy the dips mentality appears to be the Nasdaq, because it was the one where the exhale was not so strong that it pushed the blue line into the lower reversal zone. So keep your eye on the Nasdaq. It has been our leader. Of course, Apple and Microsoft and a number of those others have been kind of the story stocks of this recent era that we've been in. And right now, that's probably a smart place to be looking for renewed trends to the upside, if that is your mindset going forward. Now, I thought we would spend a little bit of time over here on Twitter real quick, because this idea that we had this market that just got absolutely blasted out of nowhere, is a bit peculiar. For those of you that have been paying attention here in the last week or so, I hope you've noticed that something has felt off with the stock market. And it certainly has been something that we've been talking about in my premium classes here in the last week at Market Scholars, and I'm sure David's probably been talking about some of these things as well. But since we're all here in this environment to learn, and perhaps you're somebody that maybe this is your first major market meltdown that you've ever gone through, and you're learning, right? And that's the way that I was as well. I started trading during the dot-com bubble. I was trading when JDS Uniphase was going up, 400% in a few months, and fiber optics were supposed to change the world, and they ultimately did. But the companies who sold them eventually, in many cases, went out of business, and it was a huge speculative bubble. And it might be kind of what we had been going through to a degree here more recently as well. So we've all been there. There's nothing like learning from the market itself. And if you felt yourself get clipped here today, remember that that's a learning lesson for you, and it's something that will serve you well for the years to come as well. And we all started somewhere, and we all had to, learn these hard lessons along the way. But I wanted to show you some things that I was tweeting just 2 days ago. First of all, thank you to the 92 of you that clicked like for me the last time around. Remember, we're trying to get to 100 or more on those. So if you appreciate these videos, they are free of charge for you. The only thing that we ask you to do for us is just simply click like on Twitter. We think it's a pretty good trade-off. You get free content. All we have to ask out of you is just 5 seconds of you clicking a button. Anyway, thank you for those of you that consistently do that. This is one thing that I did mention earlier in the video already tonight. Today we were down 6.9%. I don't know if this was the Dow. That might have been the Dow that we're looking at there. He doesn't specify. But anyway, just to put things into perspective, out of the 25 worst days in history, 4 of them have occurred in this year that we're in right now. Again, a great learning environment if you are just stumbling your way into the stock market all of a sudden. A 6.9% meltdown. We had a 7.8% meltdown back on March 9th. We had that 10% meltdown there on the 12th, and then a 12% meltdown on the 16th of March. So crazy action that we've had so far in 2020. But there were 3 things specifically that caught my eye earlier this week that kind of gave me a sense we were getting close to some sort of a major moment where we were just getting too frothy, ridiculous things taking place. So I'm going to try to find those for you that we can maybe use those as a learning lesson. And again, I've been talking about these in my classes this week with my premium members, but for those of you that haven't been to class, just to catch you up. Okay, one thing that I wanted to point out. So I retweeted this from Joe, and he says, tongue-in-cheek wise, he says, Hertz is down 28%. The market's starting to wonder if the company might be bankrupt. And this was actually yesterday. This was not today. So this was before the major plunge. And the joke there is that we have a lot of novice investors entering into the marketplace. A lot of you guys have been hearing about the Robin Hood crowd, and maybe you're part of that Robin Hood crowd. I don't know. But the point is, there have been stocks like Hertz that have already announced bankruptcy that have gone up double. Hertz was an example of it. We've had Widening Petroleum going up like crazy. In fact, I can kind of show you probably some of those charts since we're in the learning mode here. Here's Hertz. So you can see that if I were to pull up, let's do a 3-month chart on this. Let me expand this a little bit more so we can all see it. You can see that Hertz was an $84 stock. Now this was probably the day over here where they announced their bankruptcy. You can see it went all the way down to 40 cents. Well, a week ago, this 40-cent stock that's already declared bankruptcy went up to $6. I mean, there were people doubling, tripling, quadrupling their money on a bankrupt stock that basically has no value. Now you can see that if you didn't get out of that quick enough, you probably paid a pretty big price for that, as this $6 stock has quickly become a $2 stock again now that we have had a pullback. But that is a sign of froth. Another stock that has announced bankruptcy plans is Widening Petroleum, and a similar situation. This was an $83 stock a couple of weeks ago that went to $3.59. That is not normal. This is a company that likely has no value to current equity holders. Another situation that was kind of interesting, not along the exact same lines of bankruptcy, but instead fraud. In this case, Luckin Coffee. You can see that while not nearly as exaggerated, a couple of weeks ago, this stock went from a low of $1.33 eventually up here to $6.80 approximately, even though they've come out and said, yeah, we're cooking the books. This is not normal. I think most of you are aware of that, but just the fact that it's happening should have been a sign that, hey, the markets are not functioning properly right now. They're not normal. They're not hooked to earnings the way that they normally are. So that's one sign that I've been talking about in my classes that could have been a heads up that, hey, something is off. Something's wrong about this market right now. Another thing that caught my eye as I scroll a bit lower now is... here was a meme that I made, the old jealous girlfriend meme, and the reason I made this is because there's been so much talk about Buffett lately, and how he really just screwed up by selling the airlines, right? And so I said, you know what, Buffett lost a couple $2 billion. He almost broke even on all of his airlines combined, less than $2 billion loss. Meanwhile, he made $50 billion not selling Apple, but everybody has to concentrate on that. So Buffett has been a big part of this conversation around FinTwit here recently, and that will take us to this next tweet that I had right here. And you'll see this was 2 days ago, and this happened just before I did the Market Outlook presentation here on Tuesday. So MarketWatch tweets this thing out that says, Warren Buffett is an idiot, says investor who claims day trading is the easiest game I've ever played. And if you click on that, it'll take you to Davey Day Trader, a fellow that's very well known in the sports gambling world that no longer has sports to gamble on and therefore has become a day trader. And so he comes out and calls Warren Buffett an idiot, even though he probably just traded his very first stock this year. We also heard from the president. President Trump came out in a press release, or not a press release, but a press conference, and said that Warren Buffett screwed up and that he should not have sold the airlines. So, you know, these are actual, things that occurred. Obviously, it's very well known that Buffett did sell the airlines. And does he regret it now? Possibly. But the point of it is not that he made a mistake. Everybody makes mistakes. That's one of the things that I admire the most about Buffett, is the fact that he's willing to admit his mistakes, and everything is aired out, right? Everybody gets to see it. Not everybody gets to see your mistakes or my mistakes, but everybody sees his mistakes. So it's one of the things I've always admired about him. But when we start getting into an environment where there's a guy that's never traded stocks in his entire life until this year, calling Warren Buffett one of the world's greatest investors, who's been investing literally for 7 decades. He calls him an idiot. And then he also gets called out in the exact same week by the President of the United States for having a lousy stock trade. Something's wrong. There is froth in the system. What are the chances that all these people calling Warren Buffett an idiot are better investors than Warren Buffett? Probably not great, regardless of that specific scenario right there. So that is another sign of froth. You get people that have never traded stocks in their life calling one of the world's greatest investors an idiot. We are getting close to a top of some sort. So that was something that really caught my eye there as well. And then you can see here, you know, a lot of other stuff that we've been tweeting out that, you know, looks like there's some pain ahead, you know, and this was on June 8th from Abigail. And there's been a lot of this type of stuff that's taken place here lately. Here's the last one I wanted to bring up that I have been talking about in class as well. That is a sign of froth. And that sign of froth is, in this case, it was a good old hipster trader that tweeted this out, but a lot of people were talking about it. This was 2 days ago as well. Nikola. Now, this is not Tesla. This is a completely different company. Nikola, which is poised to eventually sell cars one day, I suppose, in electric cars at that. And, you know, they might very well have a wonderful product for all I know. But facts are the facts. And right now, the cars sold in 2019, Ford, 5.5 million cars were sold in 2019. Nikola Motors, 0. 2 days ago, Nikola Motors' market cap was $29 billion. Ford was $28.7 billion. So in other words, a company that has had to scratch and claw for every profit that it's had for many, many decades in a well-known brand around the world, it was worth less than a company that most people, if you asked them on the street right now, had never even heard of Nikola Motors. They've never produced a car. So it's another sign of froth. This is not normal market functioning that's taking place here. So if you had your eyes open in the last couple of weeks, you probably saw some signs that we were getting there. Today should not have been all that surprising in light of some of that particular commentary there. The timing of it is always tricky, right? This is not stuff that's on a chart. It's just, hey, your spidey sense is going up that we are going off the rails here in kind of a bubblicious territory. And that does feel like kind of where we've been here recently. And then you start waking up to these things every day like I do, the 9 at 9, and you start seeing things like Norwegian Cruises down 16%, Delta Airlines down 15%, Occidental down 14%, United Airlines down 15%, Park Hotels down 17%, right? And so you start seeing these trends develop in the 9 at 9 for those of you that follow that either on our website or if you follow me on Twitter. You can catch that at 9 a.m. Eastern time every morning as well to see which stocks are likely to be moving the markets in any particular day. And we've certainly seen a major reversal here in the last week where all of those travel-related names were loved a week ago. They've been hated the last couple of days, and we're getting back into more of a normal market environment. All right, let's get back to some more charts here. One thing I did want to point out, I had to laugh when I saw this. Hang on just a second. I got to get my other monitor. There we go. Let's go over here to chart 4C. This is the 1040 crossover method. Now, I rarely bring this chart up on Tuesdays. Part of the reason I do that is because I know Tuesday's still early in the week, and you know this is a weekly candle chart, and it's not going to be confirmed until Friday. So if I ever do bring it up, I try to bring it up more on Thursdays than I do on Tuesdays. This was a rare exception to that because I wanted to point out on Tuesday to you guys that, hey, we were having a change to be aware of. And that change was the S&P 500. At that time, just 2 days ago on Tuesday, we did have a bullish crossover. And I said at that time, if you go back and listen to that recording, I said, we're good to go with a bullish crossover unless we have some sort of a major market meltdown in the next 3 days, which I don't anticipate, but anything is possible. Well, apparently the trading gods were listening to me, and I ruined it for all of us because, of course, we have one of the biggest market meltdowns in history today, and indeed that was enough of a market give back where you can see that we're just barely right now. I mean, we are by the tiniest of scotias there. We are just barely back to a negative crossover. You can see that this purple line down here is at minus 0.14, meaning that in this case, the 10-period moving average is just a tiny little hair below the 40-week moving average. And so tomorrow we've got one more chance. If we have an up day tomorrow, there's a pretty decent chance that it will still end up locking in a bullish crossover there. Some of you will refer to that as a golden cross. On the other hand, if we have another sell-off day tomorrow, then we stay in the penalty box for one more week. Eventually, we'll probably get to a legitimate crossover, but I got a kick out of that because if you'd asked me on Tuesday, I would have said there's no chance. Now you ask me on Thursday after a 6% meltdown in the stock market, and you can see the effects on even long-term charts that a day like today would have. All right, speaking of long-term charts, I'm going to get into a long-term mindset here for a second. Many of you know that I'm a dividend growth investor at heart for my own trading and a lot of the classes that I teach here at Market Scholars. I don't get into that concept a whole lot during these market outlook related videos because we know that most of you watching are oftentimes active traders and you're more interested in the quick little swing trades here and there and some of the options trades and things like that. So we kind of reserve our long-term mindset for my premium classes for those of you that are interested in that sort of thing. But when we have a big day like today, it reminds me, hey, is there opportunity out there? If you're a long-term investor, if your time frame is more than 10 years, as an example. So oftentimes what I end up doing when I'm looking for days like this and I'm looking for opportunity is I go to the Dividend Aristocrat list. The Dividend Aristocrat list is a list of about 60, a little bit more than 60 stocks that have increased their dividends for more than 25 years in a row or more and are also part of the S&P 500. And VF Corp is a company that doesn't have the brand name appeal that other aristocrats like Procter & Gamble and Johnson & Johnson and Coca-Cola and McDonald's do. Nonetheless, it is an aristocrat, and it is a company that is a consumer discretionary stock that, of course, has been roughed up since we've kind of been stuck in our homes so much here in 2020. A lot of people are not out shopping for clothes, and that's what this particular company does. This is a company that the VF stands for Vanity Fair. For those of you that go back long enough, you might recall that brand name. And their line of clothes that they sell, they've kind of got about a little bit of a holding company type of a feel to them. But some of their more popular brands right now are the North Face, for those of you that are outdoor enthusiasts. And then Vans is another one of their brands for those of you that might be skateboarders, or maybe you've got some kids or some grandkids that are skateboarders. A lot of those folks like their Vans. So anyway, this is a company that clearly has been out of favor. And you can see it sold off from about $99 at the beginning of the year all the way down here to just a hair below 50 in the worst of the crisis in March, as most stores were basically shut down. Malls were shut down, department stores were shut down. This company probably sells a fair bit through its online channels, but a lot of their retail locations were difficult to access if you're a consumer. Even if you wanted the product, it's hard to get it. So this stock suffered as a result, and naturally so. But in the last couple of weeks, you can see that it did kind of start taking off. These are weekly bars that you're looking at here. So about 2 or 3 weeks ago, we went from about $55 all the way up here to about $70. Now today, we sold off pretty dramatically. We were down about 6% today in this particular stock. Now what you're looking at here as far as this graph is when the stock is in the blue zone, we consider that to be somewhat attractive from a longer term perspective. So as I zoom in here, you can see that we're clearly in the blue zone right here. And what this is telling us is that the current price of this stock is yielding more than this company's average high yield. This company's average high yield is 2.81%. So this is not a stock that naturally has a very high yield. It's usually more of a growth-oriented type of a company, not one that offers a really high AT&T type of a yield. So when price goes down, dividend yield, of course, goes up. And when price has gone down today by 6%, that means that the dividend yield has improved. A week ago, for a brief period of time, you can see it was trading above the blue line. So at that point, we wouldn't have been as interested in this merchandise when it was priced up here at $70. Now that it's down here at $60, where we closed today approximately, we are much more interested in that. Its current yield is now 3.21%. And you can see it spent some time in the blue zone back here as well in 2017. If you were lucky enough to be buying this one at around, let's call it $53 or thereabouts, it eventually doubled. It went up here to about $103. So it does require a bit of a leap of faith because it is involving, a consumer discretionary brand, and who knows what happens with shopping in our future. But one thing the company did say today is that its North Face brand was experiencing a sales bump as people were experiencing the outdoors a lot more. And we've been hearing a lot of those stories. Since our normal vacations have been disrupted, a lot of people are taking to the trails and, you know, renting RVs and getting out into national parks and different things like that. And they might be purchasing a little bit more of their the North Face gear, whether that's, you know, some hiking boots or some outer shells for your various you know, down coats and what have you. So anyway, I thought this would be an interesting one to add to our long-term portfolio, since I don't have this one in this particular class account yet. I do have a lot of Aristocrats that we picked up along the way. This is one of the Aristocrats that we have not picked up yet, so I figured if we're ever going to do it, let's do it when the stock is so-called on sale, and today might be one of those opportunities. Now, what I'm going to do in this case is a little bit different than what I have done in the past when I've shown you guys these types of setups. And it goes back to what I mentioned at the beginning of this presentation, which is I think we have a decent chance of saying that what happened in March was the low for this moment in time. I'm a little bit more comfortable saying that now. And so I think this is a really good environment to be legging into positions between where the stock is trading now after a big 6% drop today in the stock market versus where was its low back in March. And with this particular stock, its low was down there just a little bit below $50. So I'm going to do this a little bit differently, where I'm going to try to buy it in thirds. We'll see if this works or not. But what I'm going to do is I'm just going to buy a third of my position now. I'll try to buy another third of my position if it falls an additional $5 per share, and then I'll top off my position with a final third of my position if it were to fall $5 beyond that. So in other words, I'll buy 100 shares here at 60. I'll try to buy another 100 shares at 55, and I'll try to buy my last third if it trades down to $50. And at that point, I would have a full position, and I'd be happy to own this one for the longer term. So let's come on over here to the trade tab and put those trades in. So I'm just going to click on the ask price here. And again, my first one I'm going to put in, let's put it in at $60.01. Now this closed at $59.80 tonight, but just in case the futures bump up a little bit overnight or what have you, I'm willing to pay 20 more cents for this if it comes to it. So I'm going to put that in there as a good till cancel order. Buying 100 shares at $60.01, confirm and send, there she goes. I'm going to click on the ask price again. And I'm going to come over here and again do another 100 shares. In this case, I'm going to try to buy 100 shares at $55.01. And again, good till cancel, because that's probably not going to get filled tomorrow, but if it gets filled next week or the week after, great. Confirm and send that off, and then do it one more time. And in this case, I'm going to try to buy 100 shares at $50.01. And again, good till cancel. Off she goes. And we'll see if we can get filled. So I'm going to try to buy 300 shares here, but I'm going to do it cautiously by waiting for a bit more of a pullback, but still trying to get my full position acquired before it touches its low that it had back in March. And you can kind of see, if we go back to the chart with this green line, where we would be trying to purchase this along the way. So that's what I had for you here tonight. It was an exciting day in the market. I hope most of you don't feel too beat up after it. I feel surprisingly good about how things developed here today, quite frankly. And I hope many of you do as well, because you probably recognize that what we were going through in the last week or so was absolute craziness. And this was the market's way of resetting, getting back into a bit more of a normal trading mindset, where we're having, you know, stocks that are a bit more hitched to their fundamentals, and not just bankrupt stocks that are doubling every day, right? That is fantasy land. It's not exactly the great type of investing environment for most of us. So I'm happy to see a little bit of a give back in the market today. Gives us a chance to reset the deck. Gives us a chance to you know, go back and look at what stocks did we miss before that we want to pick up now. So with that, I want to wish you all the best of success with your trades and your investments. Remember, if you got value out of tonight's free video, all we ask of you is just to go over and click like for us over there on Twitter, and then David should be back with you tomorrow. So best of success with your trades and your investments. Goodbye for now.